Okay, well, tonight's broadcast is entitled Stock Market Trading Strategies. I'm going to be talking about a number of methods of trading. So let's get the show on the road here. Okay, to start with, this statement is pretty self-evident. We all want to make money in the markets, and in order to make money, basically, we've got to be right about the future using a stock market strategy. In other words, what we buy or sell today, we better have some sort of insight into what we're doing, and we got to be right. That's what it all boils down to. We're right, we make money. We're wrong, we lose money. So we want to look at successful strategies, those things that can lead us to where we want to be, which is making money in the markets. Now, tonight is going to be a training session. There's going to be no selling. This is a broadcast to existing owners, so we're just trying to help you guys use your software more productively. And so this is why we wanted to cover strategies. Now, first of all, there's a lot of different things that we can trade. We can trade stocks, indexes, ETFs, commodities, futures. We have lots of choices in front of us. There's three types of trades. Either you can be bullish, bearish, or non-directional. Again, we have lots of choices. Duration. What kind of trader? We want to look at a long-term trader. We want to be a short-term trader, an intraday trader. Again, more possibilities. And finally, we have a choice of either using just buying stocks, buying or selling stocks, or using options. Most of the people today use options. When we first started with Best Choice over 15 years ago, the option market was much, much smaller than it is today. And maybe, I'd say, maybe 4% of all stocks had options. Now today it's over 50%. More than half of all stocks have options. So options is certainly something that you should know, and if not, we'll teach you a little bit about it tonight. So with all these choices, how do I know what to do and when? Well, let's start at the beginning. Well, first of all, you need to be successful. And so let's start with understanding the probability of success. How is it that we can become successful? Let's consider that. Let's look at probability. So let's consider, first of all, I ask you, how successful are you doing what you're doing? I mean, if you're very successful, you probably don't need me to teach you. Just keep doing what you're doing if you're very successful and making a lot of money. I mean, it's always great to learn other techniques and stuff, but if you've got the basics under your belt and you're very successful, that's great. But if you're a loser, well, then you're right at the right place here. I'm here to teach you winning strategies. So I want you to know I'm going to teach you what to do and when. So let's start by considering some simple probability examples to kind of get across the few points of probability. So let's start with a couple simple things, and then we're going to build up. Let's talk about a dice cube which has six faces. So let's say if we roll the dice, you could either bet for or against a 1 coming up. Now, in options strategy, you can either buy a call or you can sell a call. You can be on either side. So it's the same sort of thing, or an analogous, let's put it that way. So if we bet against the 1 coming up, you win 5 out of 6 times. There's 6 faces, so 5 out of 6 gives you an 83.3% probability of success. Now, when we're playing this game, you know you're going to lose sometime, but you're winning most of the time. Okay, that's probability. It's not 100%, but it's a pretty good game to play betting against the number coming up. So let's look at a couple other probability examples. Okay, let's consider another game, turning a card over in a deck of cards. Shuffle deck of cards, and you bet it's not going to be an ace. What's your probability of success? Well, in this case, since there are 13 suits, and only one can hurt you, excuse me, one face card could hurt you, the other 12 you will win on, your probability of success is 92 1.3%. Again, hey, if you're doing that good trading, you're doing fantastic. Now, one last game. Supposing we had a race where there was only one horse running, a one-horse race. Could you pick the winner? Of course you could. That would be 100% probability of success. It's impossible for you to lose. One time when I was explaining this to a woman, she says, well, what happens if the horse falls down and dies? I don't care. There's only one horse running. He still wins. It's 100% scenario. That's what 100% means. Now, in reality, would we ever find 100% or a one-horse race? No, it doesn't really exist. I mean, I just made that up to explain to you what 100% means. Now, would you be happy with an 83%, a 92%, or 100% probability of success? Yeah, that's what we're shooting for. High degrees of success. And we want the techniques that will get us there. So, in whatever you do, you should always consider your probability of success. Now, let me go over a couple other examples of probability of success. Netflix is a stock that has gone up 15 out of 15 years when its first quarterly earnings are reported. Would you say that's a good trade to take if you have that information and you know that? Yeah, of course. It's a very high probability of success. Priceline, another stock, has gone up 16 out of 16 years when its first quarterly earnings are reported. Is that a good trade? I think so. Very high probability of success. So Sunny and I, as well as many of our office staff, took these trades this year when they came out. And these were the first two trades. One of our customers who ran a $6,500 account, that's what he started at the beginning of the year, up to 1.6 million. These were the very first two trades that he took. And after those first two trades, his $6,500 account was up to $76,000. I mean, that's pretty phenomenal. But he understood. Now, he was brand new to trading and to Best Choice Software. He was working with his trading coach. I mean, he wasn't doing this by himself. I mean, he was being helped by his trading coach. So, I mean, if nothing more, if you're an inexperienced trader, you should spend a little bit of time with our trading coaches. It's worth the time and effort and money to get some experience under your belt. So he was not an experienced trader. He understood what we were teaching. Was he guaranteed to make a profit? No. He only understood the strategy of his trades and the probability of success. So we're going to get into the first market strategy of trading, which is using our seasonals. Now, seasonals, we can look at earnings plays, which are overnight trades, and they're directional. It's either typically going to go up big, down big, or it could possibly stay flat, but that's what we're looking for, the good ones. Now, Best Choice shows you the probability of success and the average return ahead of time. Now, this is also, see, this is where I try and emphasize we're looking into the future as best we possibly can. We have to have information ahead of time. So when you look at a seasonal chart, you can see the average return. Is it 1% or 10%? You can see it from the chart. Now, let's say, for example, you're looking at a $100 stock, and the average move is 1%. Well, don't expect a $10 move to happen. 1% of $100 is only $1. Expect only a $1 move. That's what's realistic if you're seeing the average move at 1%. So we take the price of the stock, and we can, knowing what percent, we can calculate what kind of move we would anticipate. So then you want to look at your strike increments. If you're an option trader, you want to see what is realistic and what is not. I'm going to show you an example of this, but I'm just kind of setting the groundwork here to understand this. Now, there's other events besides earnings plays, but earnings are nice repeating events. Again, we're looking for a seasonal repeating event such as Christmas. Christmas causes a lot of retailers to move, and actually November, late October, November is the strongest time of year on the overall market. We've seen that year after year after year. That's when a lot of the good retailing type of trades occur. And a flat seasonal chart is no good. So I want to, first of all, show you the difference between looking at a great chart and looking at a lousy chart, so you know what you're looking at and looking for. You want to look at stocks that have these big seasonal moves. Something is happening that causes that stock to move. So let's take a look at it. This is Priceline. Now Priceline, of course, earnings comes out 4 times a year, where we show these green dots, 1, 2, 3, and 4. And it's obviously this first quarter is the big move of the year on this particular stock. Now, normally I don't have 16 years of data, but I did download 16 just to show you that over the past 16 years, this is going up 16 out of 16 years. It's 100%er, and the average move. This is where we see our average move, which is about 12%. This is what a great trade looks like. Okay. Now, let me show you what a lousy trade looks like. We go to our next slide. Now, I can show you stocks, I can show you commodities. Pretty much everything has some sort of seasonal component to it. There are a few things that don't, and this may be one of the few things that doesn't. It's the British pound. Now, if we think about currencies, the British pound is in terms of US dollars. So that's the relationship between whatever Great Britain is doing and whatever the US government or US economy is doing. That's the relationship. So is there something that occurs at the same time every year in that particular relationship? Well, not really, because the countries can do whatever they want when they want. Depending upon their own needs and stuff. So we see this relatively flat chart. And when I drag my mouse across, I can pick out the absolute best trade, which is right here, which is a lousy trade. It's pink, it's got a bad rating, it's not very consistent, and it's a very low profit per trade. So that's showing you the difference between good and bad. Now, I'm going to go in detail on the Netflix trade that happened in January. Again, we can see a big up move. This was off of my computer because I'm showing 10 out of 10 years. And we notice it's a 20% move during this first quarter. You have a fairly good quarter over here coming up in July to the downside, but these other quarters, there's not a whole lot. This is the big one right here in the first part of the year. That's the one that we like to focus on. So now, Netflix, before the earnings was announced, the stock was $333. Okay, and we know that the average move from the chart is 20%. So if we take 20% of that roughly $300, we're talking about a $60 move. Just ballpark, basically, $60. Now, the strike increments on this particular stock are $5 apart. So you could buy a call at 335. This should be 340, 345, 350, 355, and so on and so forth. Those are your strike increments. So if we're talking roughly a $60 move divided by 5 strikes, we're talking about 12 strikes, which is a huge move. Anybody that knows options, if you have a call or a put and it goes in your direction 12 strikes, I mean that is unbelievable. A lot of times if you're out of the money, you're going completely from out of the money to in the money, and you've just made a fortune very quickly. So in this case, this is a yearly event. It's happened 15 out of 15 years, and that's the average. I mean that blows your mind when you really think about it. Okay, now. This is something I've never ever explained before to anybody, so pay attention here. Now, if you bought 12 strikes out of the money and it moved 12 strikes, you would have no profit. Now think about that. Okay, if it goes to where you think it's going to go, and that's what you pay, that's your strike, well, you paid a premium for it. So not only are you not having a profit, but you're losing your premium. So you really want less than the average. Okay. Am I perfectly clear on this? Okay, so think about it. Here I got it at $330 plus the $60 is $390. So if you bought a $390 strike and it goes to $390, you have no profit. Actually, you have a loss. So it's got to be less than the average movement, which would be the 12 strikes. So we got to be somewhere less than that. Now let me show you a chart of actually what happened, so to kind of give you an idea. Okay, this is from a spreadsheet where I just copied the numbers. Here's all of the different strike increments. You can see 330. This was the at the money, 335, 340, 45, 50, 55. You could have bought any one of these strikes. And this is the ask over here, what it would cost you per share of stock. Now, the stock did go from 333 up to 388 overnight. That's an overnight move, $55 or so, which if you bought the stock, if you had the stock to the next day, you've got a 16% return, which you should be pretty happy. But look at the option returns. Who's going to be more happy, the person that has the options or the person that has the stock? The percent returns are much, much higher using an option. So, okay, this is the percent returns. Now look at where the highest percent return is. The highest percent is right here at the 380. Now, the stock did go to roughly 389, and so if you bought the 380, which means you have the right to buy it at 380, the close, it would have cost you $1.90 on January 22nd, and then the next day, this is roughly where it opened. Or no, excuse me, this is the close of the day. So it did close a little bit higher than I think where it opened here. And so going from here to here, you have roughly a 421% return on your $1.90. So that's a pretty big move there overnight. So we knew this generally ahead of time. What normally occurs, and I emphasize the word normally because when we're looking at seasonality, we're looking for repeatable patterns. Okay, so there's the jump. This is what it looked like on a chart. Actually, I think this is 2014. If I show you 2015, it looks pretty much the same. We see that big jump right there. It was roughly the same price. So that is what we're looking for in our seasonal trading, the earnings. We use our wizards to find these guys. I'm not going to go into wizard searches. Maybe when we go live, Sonny joins us. He likes to do wizard searches. But I always like to explain to people, first of all, you got to know what you're looking for. The wizard is just a tool to find the things that you want to see, but you got to know what you're looking for. And this is what I'm explaining to you here, going through these certain types of trades. Now, the second type of strategy I'm going to be talking about is our three-line. This is a 3-month time frame strategy. Now, in Best Choice, when we construct these 3 lines, they're created at certain levels. When we take the data, this time frame that we're looking at here, this center line is the average. That just means half the prices are above it and half the prices are below it. Now, did you ever hear the old saying, buy low and sell high and you'll make a lot of money? Well, it's very true, but the average person doesn't know how to apply it. What is low? What is high? Well, it's very simple. They're relational terms where you're comparing one number versus another. So anywhere's down near this line or below is low compared to this average, and anything above or this line is high compared to this average. So I've just defined for you what is high and what is low. You have to have an average to compare it. You're comparing 2 things. So when we look at this chart, I've drawn some circles over the areas that the price is relatively low. It's cheap. And up here we can see areas where the stock is relatively high. So we want to buy low where these green areas are and sell high. So if we look at this chart, there's three trades. There they are. Okay, you're buying here, it gets up high, you sell it. Gets back down here, it's cheap, runs back up, you sell it. It's cheap down here, runs up, you sell it. Okay, so you're buying low and selling high. And of course, the other way of making money is shorting. So here's our other three trades to the downside. You can sell above the upper bands where you know it's relatively expensive and buy it down here where it's relatively cheap. Now we have a rating over here, the extreme, which tells us, you see this is our 10% line. Anything below that we're going to see an extreme of less than 10. Now we can see right here where it closed on the last day that I had made this chart. It's between the 10% line and the 50%. It's right at the 17 percentile level. So yes, the day before it was relatively cheap, but it started moving on up, and now it's kind of in the middle is sort of no man's land. Okay, we really want, these are our prime opportunities above and below the band. So this is our second trading strategy, using our three-line chart to tell us good trading opportunities. Okay, so what we want to do is short the stock, either short it, I mean, you're buying puts basically. Most people, if you're short a stock or if you're going long and have a trading stop, it's really difficult, because if the stock blast lower, I mean, I've had stops years ago when I was trading stocks, and they just blast right through my stop, and it didn't do any good. So an option is giving you much more protection. You can only lose whatever you've paid for it if you're buying calls or puts. So you've minimized your risk. You know what your risk is. Whereas if you simply had a stock and you're buying the stock and you with a stop, it could blast through it. So that really doesn't protect you that much. So at any rate, above the upper line, which occurs 10% of the time, we want to short the stock or buy puts. And below the lower line, where the stock is relatively cheap and our extreme is below 10, above the line it's above 90%. That's our two levels of buying and selling. And the typical trades last 1 to 3 weeks. Couple other comments. The wider the bands, that just means the more volatile the stock is. And we can search for those in our wizard under the price consistency. If we want more volatile stocks, we want less degree of consistency. Okay, I'll show you that in a little bit here. Now, we can simply, I mean, we could use stock, just buy and sell the stock, or we could use calls, puts, vertical spreads. Now, a vertical spread is very simple. Instead of buying a call, let's say you got a $100 stock, and let's say you're buying the $105 call for $5, let's say, for example, and the 110 sells for $3. Well, if you bought the 105 and sold the 110, your net cost would only be $2. You see, so you've reduced your risk, how much you could lose, as opposed to just strictly buying a call. This is really important in sometimes when we have some of the earnings plays where just before the earnings are announced, the premiums are very expensive, and then the next day they collapse because ahead of the earnings, nobody knows whether the earnings are going to be great or bad or what. So there's a high degree of uncertainty, and the premiums are high. But after they announce the quarterly earnings, okay, everybody knows, and the premiums drop like a stone. So if you're just simply buying a call, you can get crushed, which is called a volatility crush the next day. But if you had a spread on, okay, the call that you bought drops, but so does the one that you sold drops. So you're somewhat insulated from that volatility crush. Or you can do some other advanced bull puts or bear call spreads using this three-line strategy. Okay, moving on here, the third trading strategy is basically long-term investing. When I built this program originally, I wanted to look at the price and the earnings to make sure I had great stocks, that the earnings were matching the price movement. And this is a chart of the Dow Industrial Average over the last 6 years. Basically, the Dow's gone straight up. And there's reasons for that. If we look at since March 9th of 2009, that was a very critical date when the U.S. government started its qualitative easing policy, where basically they were a deficit spending and flooding the market with more money. I think it was, I don't know, $75, $80 billion a month for a while there, and it was just money they were plowing into the markets to stimulate them because the market had been crashing, and they want people working, they want a positive economy. So since that time, the market has gone up 3 times. That's pretty gosh darn good. And so buying and holding most stocks over the past 6 years would have given you a good return. You could, I was talking to Sonny earlier, we talked about buying a put to protect your long-term stock holdings. And that's a very wise strategy, because for every 100 shares you own, if you owned 1 put, if the stock collapsed, well, then you've got your protection to the downside. Puts act like insurance policies. If you have a very expensive house, you really wouldn't want to own that house without an insurance policy. You know, suppose the house burnt down, you just lost a lot of money. But if you did have an insurance policy, well, then you go to the insurance company and say, well, pay me. You know, so you're covered for your loss. So that's what a put does. Okay, let's talk about some more. On the third trading strategy, this was what the Dow looked like from 2007 to 2009 during the real estate crash. It was not a good time to own stocks. Now, probably the best strategy if you wanted to hang on to your stock was to own 2 puts, because not only would you 1 put offset the loss, but the second put would put you into a profit. Actually, you're looking for the market to go lower. So again, that's one variation that you can use. It's just what is the market doing right now? And I think we're still in a relative period of accommodation. Interest rates are low. I don't see them going up for years, because certainly just having a higher interest rate would cause the government to have to pay more money on the debt that it owes. So that's kind of counterproductive. Anyway, let's go to our 4th trading strategy, which is our show targets method of using options. Now, this is really cool. First of all, this is where we want to use our stock search wizard to find specific kinds of stocks. We want to find high growth stocks. A stock, let's say, over the past year has been growing better than 30%. We want to find a stock that also has high earnings, where the earnings are growing better than 30%. So this would be a stock that's making money. We know that whatever they're doing, they're selling product, they got a good profit, and the price of the stock is going up. And finally, we want a stock with a high degree of consistency. That means narrow bands. When the consistency is better than 90%, that's pretty gosh darn narrow. If it was 100%, that would be a stock going up on a perfect straight line on our log scales. So those are the 3 conditions that we want to look at. You might want to throw in high volume make sure the stock has good volume, and possibly make sure it has options, because this is an option strategy. But let me start by showing you what I'm talking about. Here is a stock, AVGO, and if we look at it, its price has been growing at, I have it underlined here in red. The price growth has been 110%. The earnings have been growing at over 200%. So they're making money faster than the price of the stock is going up. And the price consistency is 96%. So we got fairly narrow bands. Now notice this is bouncing back and forth, buy, sell, buy, sell, buy, sell, buy, sell. You could keep doing that if you want to do that. This is a great stock using that strategy I showed you earlier. Of going back and forth the bands. This shows it perfectly. But we're going to use something slightly different here. We're doing some projections into the future. So If we click on this button up here, which is our show long-term price projections, this is what we see. It shifts the price action over to the left, and it shows us these blue, these are call lines, these are our put lines. Now, the dots are at options expiration dates. So we can, this is probably a June expiration, this might be this September, October, this is January of 2016. So what we have, these are the three most common options. The center lines are always the at the money options. The inner two lines, this is the in the money calls and the in the money puts. And the outer lines are the out of the money options calls and the out of the money puts. Think of this as a cone, a sideways cone. If it's inside, they're in the money. If it's outside the cone, they're out of the money. So what we have here is, okay, the stock is right here about 140 some odd dollars. Now these blue dots indicate the strike price plus the premium. So if you buy a call, you're paying a premium. On a $160 stock, I don't know what the premium is. It could be $10, $15, $5, whatever. But you're paying a premium to lock in that option. So if you want the stock, you have to pay the strike price, which could be $140, whatever. But you don't mind paying that if it's a $200 stock. You see, because this number up here shows us where the line, these three yellow lines would be, I mean, because they extend off the chart, where they would be on options expiration. All you have to do is move your mouse over to the dots and you'll see what the price is at options expiration. So keep this in mind. We're looking at January 2016, and if the stock just keeps doing what it's doing, we're looking at that level in the future. Again, this was the button that we clicked up here. So now the next thing what we want to do is click the Show Options Chain button, which is this one up here. It looks like an option chain, just a chain here, and that'll pull up our option chain so we can see all the different prices for our options. And again, they're in groupings, like this is the different months. This is June, this is October, this is January 2016. Here's even January 2017 if we wanted to look at those option prices. So we click on this button up here and we see our option chain come up. Now, what I've done is this is a drop-down window here, and I've selected a January 2016. And this is what the options would cost us today to lock in these specific prices in 2016. Like, for example, to buy the 140 call would cost us $14. It's about 10% of the underlying stock to lock in this price for all the way up to January 15th. So as long as the stock closes somewheres above 155, we'd have a profitable option buying this particular call. But we want to use our Show Targets button up here. So this is the button that we click to use our Show Targets method of calculating our options on January, the January 2016 option. So the first thing it asks us is to enter a stop. It says, please enter the stock price of the stop so you on this trade. A good stop would be the previous pivot low, below it, or above it if you're. So we just put in a number below the current price, 140. The stop is just as long as it's below the current price, you're fine. 140, because you're probably not using a stop anyway. You're just simply buying the call or buying a put. So let's set it at 140. Okay. Now, when you click OK to that, the next window that comes up, it says, please enter stock price where you think AVGO will be in the time frame of the option expiration selected. Okay. Again, when you're buying an option, you're buying a certain length of time. And so our time, we were looking we're looking for an option out to January 2016. So a good way to do this is look at the bottom yellow band on the option projection charts for a minimum of where the stock should be. So we type in our $200 target. So we click OK to that. And then we get this, it pulls up this information right here. And it shows us that under this window, it gives us a profit percent. You see here again is the prices of all of our options. And the best one for this particular scenario of it going up to $200 would be this option right here. You got a 25% return, okay, which would be the 180 call. The 180 call, it's going to cost between $2.55 per share or $3.20. It's a whole lot cheaper than this at the money. If it costs us roughly $3 or $300, again, each call represents 100 shares of stock, it's going to cost us $300 to give us the right to buy it at 180. Well, if the stock is at 200, that's $20 higher times the 100 shares of stock is $2,000. Our return is $2,000 on a $300 investment. That's what this chart shows us. So this is really cool. This is projecting into the future. Remember I said from the very beginning, we've got to be thinking about looking into the future on the trades that we make. And this is how we can use our show targets to do that. Okay, so I've gone through 4 strategies. Let's go through a 5th strategy here now. Using calendar spreads. Now, a calendar spread is a strategy for relatively flat stocks. You're looking, the first couple strategies I was showing you was for stocks either going up or going down, things that we can do that are have proven to be very successful for our traders. Now I'm going to show you something that's relatively flat. What you want to do is buy a long-term option and sell a short-term option of the same strike. Okay, let me explain to you how this works. Let's use Oracle, for example. On Oracle, if we went to the same options table like I just showed you, the at-the-money option, ATM stands for at-the-money, it's about a $41 stock. So the July, which is going out 1 month from today, the July options sell for $1.07. And if we went out to the January 2016, 41 calls, which are also at the money, they sell for $2.72. Okay, roughly it's a little bit more than twice as expensive as the short-term options. Now, the difference is the short-term July call only has 25 days. The longer-term January 2016 has 207 days. So if you buy this, you're buying a lot of time. This one here does not have much time for it to work or to change. So the short-term option time value is more expensive on a per-day basis than the long-term option. This is how it would work out. On a per-day basis, the July costs, this should be $1.07. $1.07 divided by 25 days is about 4 cents per day versus the January 16, which is $2.72 versus $2.07. So this is about a penny a day. So you're talking, you're buying the cheap one and selling the expensive one. And so what happens if the 25 days pass and the stock stays flat? Guess what? The July option becomes worthless. It's worth $0. But the long-term option keeps most of its premium. So your July option expires worthless. You keep your $1.07 that you got from selling it. Remember, you bought this one. You subtract that from it, so your cost basis dropped to $1.65. And then at the end of July, it's worthless. So you keep the premium, and then you can sell the August. You can do it again, You can do it again in September, do it again in October, do it again in November, do it again in December. You got six times you can do the same thing over and over and over again. As long as that stock stays flat, you're going to keep the premiums. So this is a strategy that is fine when stocks are flat. Usually, again, I should say normally, summertime is a good time because stocks, most people are thinking about vacations and are not trading stocks. So the market is normally pretty flat. So that's a good time for this particular strategy. Okay, and here's Oracle. You can see over the last 6 months or so, it's been flat. It's gone nowhere. The three lines are flat, showing you that just bouncing around. Again, you could do your back and forth if you want to do that, but the stocks, it's been flat. Okay, so first, in summary now, I've been talking here for 45 minutes here. I've shown you 5 good winning strategies. I've shown you the seasonals, which are mainly for earnings plays. Again, you can use Christmas, or you can look at the seasonals for where the stocks typically go up or typically go down. You know, a lot of times, like I say, prior to Christmas, there's a lot of good retailers. In the springtime, a lot of the energy stocks move up. Okay, you can use the 3-line charts for your buying and selling opportunities. You can use your long-term growth charts where you can find stocks with good price and earnings growth. Our man who does our Yahoo users group, he calls them his long and strong strategy, looking for good quality stocks. He's more of a stock man. And the fourth one I went over was the show targets method of selecting the price target and the correct option or the best option for that particular target. And the fifth method I showed you was calendar spreads for relatively flat stocks. Now there's other strategies. I've selected 5 that I like. For example, flat stocks, you could do condors. You know, there's other good strategies out there, but these are our bread and butter strategies that we really like. Especially, I mean, most people love the seasonals because they're easy, and like I said, we had one man going from the $6,500 to $1.6 million, and people want to hear from him. You say, geez, how did you do it? You know, they don't want to hear from Sonny or I tell the story. They want to hear from the man who actually did it. Well, he did it by using the things that we taught him, and he understood them, and he applied them. You know, if you don't apply this stuff, you're never going to get anywhere. So, you know, you're always taking a risk. You know, there's no guarantees in this business. You're taking some degree of risk. So no one is perfect, but you always want to minimize your risk. You don't want to take huge risks. The flip side of buying a call and a put where you taking a small risk is to sell a call or a put where if you know, a naked put means somebody can put the stock to you. I'll give you an example. One time I had a lady at a show. She says, man, I make good money from selling puts. I said, well, what exactly do you do? She says, well, you know, if it's a $50 stock, I don't mind buying it for $48. So if I can collect a couple bucks and somebody wants to put it to me for $48, I'm happy. And I said, well, okay, if it's working for you, that's great. Fine. Well, a show or two later, I saw her. I said, how's your strategy going? She says, terrible. I said, what happened? She says, well, it was a $39 stock, and I thought, well, if it got put to me for $37, hey, that's great. Well, overnight, the company was being sued, and the next day it opened at $20. And guess what? She had the $20 stock put to her at $37. She took a massive loss. So that's the wrong way to look at it. Collecting a little bit of money to take on a big risk. You kind of never want to do that. You always kind of start off by looking, what can I lose if I'm wrong? I want to be right. But if it's just a little loss, okay, no big deal, on to the next trade. But you got to have winning strategies, not losing strategies. So, like I say, nobody's perfect in this game. You want to minimize your risk, so if you're wrong, you're not going to lose a whole lot. Now, our wizards are available to help you find trades. Now, you must know what you're looking for to use the wizards. This is important, really, because people go willy-nilly and they're not really sure what I'm looking for. But I love, Sonny showed me all these wizards and I can do all these whiz-bang things, but I don't know what I'm doing. So you got to know what you're looking for. That's the wizards that help you to find those things. So this is why I wanted to talk to you about strategies tonight, so you kind of know what you're looking for. You have an idea when you're using the wizards. Okay. And finally, remember, to make money, you got to be right about the future. And we have the tools in Best Choice Software to help you look into the future, help guide you on your hopefully successful method of trading stocks. And we have our trading coach, Gary. He's our main man who's been doing a superb job for those people that need a little help. Some people get this stuff right off the bat. Other people need some spoon feeding. But our man that had that fantastic return was working with the trading coach, and so he found that was a great value to him. Okay, well, with that, I've pretty much finished what I wanted to talk about tonight. I know I've got Sonny here. Sonny?
Wait a minute, Pete. While you're talking about the coaches, you ought to mention to them that Gary, who is our head coach, he is also a fantastic trader. And every Monday at 4 o'clock, he conducts live training showing stocks that are ready to move. And he does this, it's a subscription. I think it's $100 a month. But every Monday, he has a great number of people tune in and they interact. And the profits that some of these people are making is just unbelievable. So since everybody tuned in here tonight owns the software, you're eligible to join in on his trading group. So if you're interested in that, the office number there, you can see it on the bottom left of the screen. You could call tomorrow, talk to the girls. Of course, today being Monday, the next trading session would be next Monday. But that would be worthwhile, because once these people join that group, man, they just stay there. They look forward to every Monday, and they're making a lot of profits. Now, I know that you were going to turn it over to me, Pete, to use the wizard, but I'm in a position, as you know, that my computer, something happened, and I cannot open up Best Choice. Sonny? So I can't do it on your computer, Pete, because you use a finger pad, and I can't use the finger pad. So I have to use a mouse, and you don't have a mouse. Now, there's a picture right there that I think deserves explanation. A lot of people, we probably have some people tuned in tonight that are not, they own the program, but a lot of people aren't using it. Maybe because they don't know what to do or they haven't been taught. But this picture right here can be very confusing to a lot of people, and I think it's worth explaining what are all those blue lines and what is the yellow line, and we look at a regular chart without the blue lines. Can you show them something? If your program is up, show them a stock first, show them the stock chart.
Okay, sure. If we look at the regular chart, certainly this is what it looks like. You don't see these seasonal moves by looking at a regular chart. You would never know. I mean, you can see the gaps. You see the gap on Netflix here in 2013. It had a jump here again. It's very difficult. Here's a gap here, the gap here, and so on and so forth. But it's a whole lot clearer when we go to the seasonal chart. Now,
what is that seasonal chart? Explain it.
Okay.
All those blue lines are every year of the past.
Yeah, it's a composite of each year. Now, if I click on 2015, this is what I like to do a lot of times, and show people the jump. You see that here's 2015. We had a big jump right here. Now, if I go to 2014, we also had another big jump right there, which I showed you in the using the candlestick chart. Here's the jump in 2013. You see, same thing, same time of year, And so we can look at all the different years and we see the same jump occurring over and over and over again. This is 2011, what it looked like, the big jump right there. So on the particular year, we can see this is what happened in 2000. This is the high of the year and the low of the year, but we're focusing on specific time periods on that certain stock. Okay.
Very good. So in other words, the blue lines are every year's action put on one chart, and then the program will analyze it and produce that yellow line, which is a composite. It's a behavior, really. It's a behavior of all the past years. And you won't see this in any other place on the face of this earth. That's what makes things so exciting about Best Choice and so unique. And by the way, one thing that I do want to mention too, that Pete showed you some strategies, but you know, there are many, many ways of making money. And Pete just did mention it early on about you can day trade. And we do have a group of people that are doing day trading only on the SPY. And there's a man that's shortly going to be doing a presentation that took in competition, he took $1,000 and turned it into $100,000 in 1 year. And just to prove that it wasn't a fluke, he did the same thing the following year. Everybody started with 1,000, and at the end of the year, there was a contest, and at the end of the year, who made the most money won a prize. Well, when you got a man taking $1,000 and turning it into 100,000 in 1 year, trading nothing but the SPY, that's done on intraday trading generally, and sometimes the trades can be 10 minutes or a half hour, but they're usually started, and you have to sit in front of the computer to do that, so that's live. But there's so many different ways to make money in the market.
Hey Pete, we have some people that have some questions about Netflix coming up here soon in July. Can you highlight that trade in July?
Sure.
Can you hear me okay also, by the way, Pete?
We can hear you very well, Brett.
Okay.
Okay, so all I have to do is drag my mouse over it, and it's 11 out of 13 years. It's not 100% like it is over here in January. One thing, let me explain to you about the January time period versus the July time period. Think about January. Now that is reporting earnings that occurred from the 1st of October to the 30th of December. Brett, I think I'm hearing a little feedback in my mic, my headset.
You sound fine, Pete.
Oh, okay. That's good. It's looking at that time period, which is Christmas and Thanksgiving, when a lot of people are home on vacations, kids are out of school, and it's cold outside, and they're watching television. A lot of television. They want to watch movies. They may have some friends down visiting, and hey, let's look at some new show that came out. Let's at home here on our own TV. We don't have to go to the movies or anything. So there's a lot of activity going on Netflix that time of the year, which translates into profits when it's being reported in January.
Drag your mouse on that.
Over here. Okay.
Yeah, drag your
so
mouse.
that's why, at least on my chart, I showed you the chart that showed it 16 out of 16 because I had more data, but certainly 13 out of 13. It really doesn't matter as long as we're seeing lots of movement and the percentage is still about the same, 20%, like I showed you in the PowerPoint. Okay, so that is a very strong time period. Now over here in July, it typically falls. Now we could say, well, why would it fall in July? I understand why it goes up in December, but why does it fall in July? Well, people are probably on vacations. They're wanting to go somewheres, and they're more interested in being outdoors and enjoying the summer months rather than sitting inside watching television, you see. So that is not a necessarily, and again, I'm just giving you some possible reasons, because bottom line, do we really need to know the reasons? No, but it's kind of helpful if we understand the logic of why this or that particular stock is doing certain movements at a certain time of the year. There's some reason behind the moves. Okay, but we see that this down move is 11 out of 13. It's a 12% mover. So if we look at Netflix, if we look at the current price, and I know it's been on a tear lately, it's a $700 stock. Okay, close as well, 650 or so. So if we go to the seasonals and we're talking about a 12% drop, what's 12% on say $650? Well, what are we talking about? $70, $80 drop there? That could be substantial. You know, strike increments. If the strike increments are $5 apart or $10, we calculate what are the strike increments by looking at the chart, and then if that's the average, we don't want to be at the average. We want to be less than the average, like I've explained to you in the PowerPoint. Maybe 80% of whatever that average is, to be on the conservative side. That will give us a cheaper option. Go ahead. What, Sonny?
Why do you have that screen up there? Show them how they can drag the mouse all the way across the screen from left to right and let the computer show you the best trade on any particular stock.
Sure. Just
watch this.
Drag it across, and it immediately goes to the best trade, which is right here. So on any stock that you want to look at, like if we went to Priceline, PCLN, all you have to do is type in the symbol, enter it, and I have no clue about the stock. I just drag my mouse. Tell me where the best trade is, and it's right here. Oh, actually, it's right here on this information here. 13 out of 17 years. Okay.
It's because of the profit.
Yeah.
And the rating, yeah.
Yeah. So at any rate, whatever stock we look at, you know, we can select time periods, whatever time period we want. We have the color. If it's a lousy trade, you see it comes up as pink, where like it's only a 4% move, and it's 10 out of 16. So that's almost 50. It's a 50-50 deal, and not a whole lot of money. It's not a great trade. If it's blue, it's a better trade, 11 out of 16 at 9% profit. But when we come over to these strong ones and get the greens, giving a 16 out of 16 with a 12%, that's got higher probability of success and a higher percent of profit. The rating is a method of standardizing the trades. We take into account, you know, we multiply the probability of success times the percent return and divided by the number of days. Those three components will standardize any trade, and that way it doesn't matter whether I'm looking at Priceline or Netflix or Apple. If it's green, it's good. Brett, do we have any other questions from some of our listeners?
Yeah, if you could go back to Netflix, please. We did have a few people asking about the dots. The dots obviously are the actual earnings from each year. That's what those represent on the yellow line. You can see actually when the earnings are actually coming out at each, you know, the 4 different times of the year.
Show them, Pete, with your mouse.
So I think everybody can see the green dots.
Let me reiterate that a little bit, Brett. We have groupings of dots because earnings don't come out on the same day every year. So when we show the group of dots, that's approximately over all of the past years, maybe this dot might have represented 3 years that the earnings came out on this dot, and then so on and so forth. But this is when the earnings have come out, and that's why there's like a cluster of dots. If they were always on the same day every year, which they're not because of Saturdays and Sundays and different reasons, we would see just one dot if they were all on the same day. That's why we show the clusters.
The reason why you were maybe hearing an echo, Pete, is because you're talking actually really a lot louder than you need to be. Hugh had mentioned that you were kind of clipping earlier, so and my mic is actually picking you up from all the way over at my desk. So that's probably what was causing the echo in your microphone. We did have somebody ask, because I don't know if everybody's heard that Netflix is going to split sometime in the near future. I don't know the exact date. And so they're asking, well, is that going to affect, how well it works seasonally? And it's not going to change the percentage of the seasonality, the average percentage return. The only thing you're going to notice going forward, depending on how it's going to split, and I don't know if they've even announced yet, what the split's actually going to be, if it's going to be 1 for 2, 1 for 3, or anything like this, but we did see the same thing with Apple when Apple split their stock. And it didn't change how well it worked, it just changed the actual dollar amount that it might move. It's still going to move the same percentage, but if the stock is cheaper, it's just going to move a smaller dollar amount is all. So we did also have a question here real quick. Someone was asking, because Peter was talking earlier about sideways moving stocks and how you could find sideways moving stocks possibly for the summer. You can use the wizard to search for growth rate stocks over the next 6 months or in the past 6 months, maybe 3 months, depending on what your time frame is. And you can use the stock wizard to search for stocks that have a growth rate of maybe from between -10 to +10. Stocks that are basically no growth rate or have had no growth rate over the last 3 to 6 months to find stocks that have been moving sideways. So that's one thing that we haven't really talked about in the past as much either. That's actually a good idea if you're looking for stocks that are just kind of congesting and moving sideways. You can use the Best Choice software to find those types of stocks as well. I'm sorry, Sonny, were you
I was going to say, whoever's got control of the screen there, why not go to the regular chart, logarithmic, and then also bring up the wizard and show them the conditions. That's all. Just bring up the wizard. Now, see those conditions on that bottom scroll bar there? Those are conditions that you can pick and choose to satisfy whatever you want. Now here's Brett, he just put on extremes, and you can see all of the different items that he's clicking here, turning off the futures. There's 7,800
yeah, if we're just looking for, right, we're just looking for stocks there. We got 7,500 stocks, and of course if we're just interested in trading options available, that cuts it about in half. Typically what we like to see is fairly decent volume. We've done this many times, average volume. You want to kick that up, and again you gradually get rid of stocks that we're not interested in trading, and maybe a price criteria. You could put in a current price. You're not interested in trading penny stocks, so we could bring that on up.
Go on up to $50.
All right, bring it up to $50, and let's say we're looking for growth stocks. Okay, so we still have 600 stocks. That's a lot of stocks. So let's say we wanted a good price growth. We're looking for long-term stocks. Where's price growth for the last year. Okay, for 1 year, and we want to bring up fairly high price growth. Now each time we do this, we're getting less and less stock, so we want to watch these numbers. We don't want to get them down to where there's next to nothing, and we want a good consistent stock. So let's pull up price consistency for the last year.
All right, Pete, you're not showing what I was discussing earlier. You're showing something completely different here, right? You're showing good growth stocks, not stocks that are trading sideways.
Right. I'm just showing to find some great growth stocks that are just cooking right along. This is, and then I'll do that for you, Brett. I'll pull up some sideways stocks. Okay. Here we have 72 stocks. We'll save them to a list, and we'll call it growth. Save. Because a lot of times people are, whoops, I'll call it something else. I've already used that name.
Put in growth 622.
I could date it, yeah, but I'll just put a grow, just save it, and then we can come over here and I'll pull up my list. It's easy to do. Grow, and then, okay, well, here's one that is a bad one, let's say. Let's come down and, oh, we want to look at price consistency, so let's see something that's for 1 year. I got to
look at your list.
Yeah, I got to pull up 1 year. Okay, so here's the kind of stocks that we were looking for. You see a nice, smooth, relatively narrow bands. These are stocks that are just kind of cooking right along, that have had a great growth streak. And, you know, like when I was showing the back and forth, you want to buy and then sell up here, you're not too crazy about shorting because it's not going to pull back as much. You're going to have a better bang for your buck on the way up simply because it is a great growth stock than the pullbacks. You see, the pullback is not much, but then you had another spurt up and then a pullback and then another spurt up. You say, this is because it is such a strong stock growing at 127% compounded annually. But I found a whole bunch of them here for you. See how easy it was for me using the search wizard because I knew what I was looking for. Now let's do the same search that Brett wanted me to do. I'm sorry, Brett, but we'll go ahead. It's very easy to do. I can come down here and go to start all over again. List by exchange. Let's just redo it. I mean, you could do this many, many times. I mean, once you've done it a few times, it's pretty easy. We got just all the stocks, average volume.
While you're doing that, something that should be mentioned is that when you build up a group of conditions, you can see that save button in the middle of the screen up there, and you can save it. And anytime you want to use those same conditions, just pick up that particular search, and you don't have to do this step by step.
Okay. Now, in Brett's listing, instead of looking for great growth stocks, we're going to pick up a price growth rate for a year. Now, what we're going to do is bring it on up from the bottom and down from the top. So if we have a growth rate that's relatively flat.
Set it for -10 and +10.
-10 and +10? Okay, that's fine.
That gives you a little bit more room. Otherwise, if you're at just 1 and 1, you won't have many stocks.
Okay, so there we have 156 stocks. Now, I could put in a price consistency thing, or I can
wouldn't.
actually
That's
sort
not something to do with it.
Right. You see over here, I sorted them by price consistency. So let's just use this, and we'll call it flat. Well, I did flat once before too. So let's call it flat.
Flat number 2.
Flat 2. Yeah, that's fine. Save it. And so we can come over here to flat number 2 chart. Flat number 2. That's a lousy one because it had a bad.
You didn't put in the list stocks that have only traded in the last so many days.
Yeah, I didn't put that in. So let's look at some of these other guys here.
Well, they get the idea because we're getting to the point where we have to close down here.
Okay. Ignore.
Yeah, I just want to make sure people weren't confused with the first search you did being right after the question as far as what you were actually searching for.
Yeah. Okay.
Now, on the other hand, I like to.
But while you're showing that,
Go ahead, Brett.
Go ahead. If you're going to say something about what we're doing right now, I had one other thing that I was going to bring up that somebody had mentioned. But go ahead, Sonny, if you want to go first.
What I was going to say is that while Pete and Brett here are searching for high growth and consistency, you can use the wizard like I do many times, and I look for volatility. And I want to see stocks that are going up and down like gangbusters because I like to trade off the yellow lines. When they're below that line, looking at today, and they're way down there, the extreme is 2 or 3 or 4, that's a good shot that it's going to go back up. And if you're looking at 6 months or a year, and you can see, based on the past, you can see that activity, that allows you to get these short-term quick trades.
Yeah, I was going to say 1 year is really probably a little bit too long for a search like that looking for sideways stocks. I mean, you can see the stock does meet our criteria at 9.1% price growth, or 9.5%, but you might want to even limit your search a little bit more to maybe -5% and 5%. That'll give you some stocks that are a little bit more flat than what this is showing right here. But you know, you can use different time frames as well, but I would probably use 6 months and not a year, because you want to, a trade like that, you want to look more at what it's been doing more recently, not over 1 year ago. So real quick, because I know we're getting short on time, someone had mentioned this as far as going back to the Netflix trade. If you can pull that back up again, Pete, because we kind of got off again before I could get some of these questions answered. Pull up the seasonal if you would again, please. Por favor, and highlight that July trade. This somebody had mentioned something that was really good about this. You can see 11 winners on the right side and 2 losers. That is, Pete was talking earlier about a card game, where you're basically trying to bet that an ace won't come up. This is an example of, well, you're betting that an ace and maybe a 2 won't come up. It's still a very high probability trade, but it's not 100%. And so it's just something to keep in mind. All of the seasonal trades, we try and point you to the highest probability trades, but obviously, there's a lot of trades out there that aren't 100%, and even the ones that have been 100% won't necessarily have a 100% chance the next time to be profitable. There's always a small chance that it may not work out in any given year. So somebody had mentioned that earlier, and I just want to make that kind of more clear as far as trading with the probabilities. The seasonals really help you trade with the probabilities. But again, they are probabilities, the probability of success, like Pete was mentioning. So with that, we will be sending you guys a link. People had asked as far as if this webinar is being recorded. We will be sending everybody a link of the webinar here in the next day or two. And that is all the questions that I have from this end.
Okay, well, in summing it up, hopefully what we accomplished tonight, since this was just presented to owners of the software, is that we showed some new things for existing users, and hopefully that some of the people that have the software, and it's often the case, people will buy something and then later on they quit using it, that this will revitalize their thinking and let them come back in. You take advantage of what you learned tonight. We're available for questions, and we will be doing training webinars. So with that, why, we thank you all. We had a wonderful turnout.
Hey, Sonny?
Yes?
I'm sorry to interrupt you. There was one other question, if I can just take 30 seconds here real quick before we go, that I thought was really critical. When Pete was discussing and showing the show targets with the options, when he first started the webinar, Pete had mentioned that if you think a stock's going to a certain price, well, you can't use that exact strike if you bought a call, because that option would still expire worthless even if the stock got up to your price by expiration. You have to buy a more conservative strike, and then when he was showing the show targets and he was looking at a target of 200, our software showed you the exact best strike for that target, which was the 180 strike. So that was a good example also of how you can't necessarily buy the exact strike of where your target is on a stock. You have to be more conservative and use our software to show you which is going to be the best strike to buy for that target.
Good. That answered somebody's question. That's good.
Very
well,
good
with that, Pete, you got anything you want to add before we thank everyone?
No, I certainly enjoyed this evening presenting this information to you. I think it's some of our people were saying, boy, this is long overdue. Well, we've kind of been teaching this all along, but in not really organized in the fashion that we did tonight, to kind of group it together to give people successful strategies. Because after all, that's what our software is all about, finding success. And so we've given you kind of a few things to mull over, hopefully reviewing things that you already know. But if not, some new things, and we're here if you got any questions or anything, and we like to see everybody making money.
Amen. Amen. Well, with that, I want to thank everyone for joining in, and next time you get a notice, come on in again. We'll be here.